GM, good morning. Welcome to Milk Road Macro, the weekly macro show that is very glad the bill has passed because the words stable and genius don't belong in Congress. I'm your host, Jay Hamilton, joined by my co-host and the new host of Milk Road Macro starting next week, John Gillen. It's Wednesday, July 23rd, and today our guest is Danny Dayan, a former hedge fund manager and current global macro investor with a big following at X, as well as his macro newsletter and research hub macro musings on Substack. Today, we're going to talk about the top contenders to replace Jerome Powell and how they could impact markets, the U.S. economic re-acceleration. Is the U.S. economy about to blast off? What's the current setup and what does that mean for markets for the rest of this year? And of course, as an investor, how do you position yourself within all of this macro? Where do you find the signal within the noise? That's what Milk Road Macro is all about. I got to let you guys know quickly, do me a favor. If you like this macro content, you're going to want to go over on YouTube, on X, or on Spotify or Apple Podcasts, your platform of your choice, and you're going to want to subscribe to Milk Road Macro. Because starting next week, this content is going to be published on Milk Road Macro, not the Milk Road Daily Show. Every week, we're going to have 2 macro shows. Some content will be posted here, but most of it will be over there. So make sure you go subscribe wherever you listen to this so you can stay on top of all the macro news and make sure that your portfolio is positioned within the macro setup. Today's episode is brought to you by Definitive, the leading multi-chain trading terminal trusted by funds, DAOs, and pro traders. It's also brought to you by Ledn. Get cash without selling your Bitcoin. Without further ado, we got John in the house and Danny. Danny, welcome to Milk Road Macro.
Thanks for having me, guys. Great to be on the show. Great to talk about macro at a really important time.
Absolutely. I thought a great place to start today would be with something that Jay mentioned up front, which is the re-acceleration we're seeing in the markets. In the Milk Road Macro newsletter, we've been writing about this for a while, some of these indicators that have signaled a return to bullish sentiment. You've also been writing about this a lot on your Substack. Tell us about how you saw this, because I feel like a lot of investors have been very uncertain, even bearish, and you've been one of the first people calling for this re-acceleration. Tell us what you're seeing and how you see it playing out in the rest of the year.
Sure. Financial conditions is a very important part of my framework in understanding sequential growth, right? So at a steady state, if we have big movements in financial conditions, that impacts the economy within, a couple months lag. So if we go back to the start of the year, we've had a pretty big shock from this whole tariff policy. Uncertainty went sky high. Financial conditions naturally tightened as we saw the equity market plunge, have very big, volatile days. But in the actual economy, nothing's changed. And I think that's important. The impact from tariffs has really been de minimis thus far. It will play out over time, and we'll see, and I'm sure we will discuss over the show how it could play out. But so far, the actual impact from tariffs is very, very small. It's only starting to hit the economy now. So when I looked at, the recovery in asset, prices, first we had a oversold bounce from, the extreme sell-off, but then it persisted beyond that as the White House, every incremental announcement was an improvement, was a de-escalation for quite a long time until this month when they reinstituted, tariffs at higher levels. Every announcement was about taking the temperature down. This whole TACO theme and all that was, all in that line. And, we're seeing, in my opinion, the markets are telling us the economy is reaccelerating. So Q1 and Q2 are very, very noisy due to the shock that we had and the front running, as well as the reversal of the front running of tariffs. As we've gone through some of that inventory of goods that were front run, now we're starting to see it impact the economy. We saw a little bit of this last week in retail sales as well as in CPI, and we'll see the impact going forward. I don't think it's an immediate, slamming of the economy, and we'll have to find out. But right now for Q3, what I'm seeing is financial conditions are basically at 2021 levels. One of the obvious drivers is equities have surged. The Nasdaq, as an example, up over 40% from the lows, is now, up on the year about 10%. So that improves household wealth, especially for the retail sector, which has been the big buyer of equities. They've benefited from this, or will benefit from this. That should improve consumption, and I also think that the labor market is tightening as a result of this. So I think demand is improving, and the big picture impact from these policies is still to come. The dollar is the other aspect of financial conditions where I see a lot of misunderstanding on how this impacts the economy. But this is a huge impact from the sharp weakening of the dollar. We've almost unwound 70 to 80% of the entire 2022 tightening that was imposed by the dollar in 4 months. This is a huge, huge, huge impulse, not only for equities and risk assets and commodities, which all do well when the dollar weakens, but it also is going to have an impulse on inflation with a lag. And I think, people are a little bit complacent about that risk.
Gotcha. So there's a lot of topics you raised there. I want to start with this idea about monetary policy and financial conditions. A lot of people have criticized Jerome Powell specifically, but the Federal Reserve more broadly, saying that keeping interest rates high where they are is too constrictive of a monetary policy. And it sounds like what you're saying is, in reality, financial conditions are much looser. Could you kind of talk about that? Like, what is the disconnect between the higher interest rate and the looser financial conditions you've described that they're supporting this bull market?
Let's look at it in three different ways. Number one, they have a dual mandate, and neither of those two mandates suggest they should be doing anything right now, cutting, in particular, cutting rates. Unemployment rate is below their estimate of full employment. In my opinion, it's going to go lower. And we can talk about the supply side of the economy and immigration and all this. Inflation has been above target for 4.5 years. And the Fed themselves is projecting it to increase this year, to reaccelerate a little bit. And we'll see, how persistent that is. I have my own view that's probably different than most. So based on the two mandates, if you're data dependent as the Federal Reserve, the default stance should be nothing, right? They shouldn't be giving speeches talking about rate cuts. They shouldn't be projecting rate cuts. That's prejudging and making assumptions. And I think that has led them astray, all cycle. I think going by the two mandates, certainly they should be doing nothing. The second way I would look at it is and I posted about this on X today, so anyone who follows me can go check out my tweet this morning. But the way we look at the effectiveness or restrictiveness of monetary policy is quite simple. When they raise rates, it takes time for the various actors in the economy to refinance at these higher rates. It's not as if they hike rates and then tomorrow everybody sees their effective interest rate on their debt that they have go up, right? It takes time until you buy a house, buy a car, refinance, or as a business, issue new bonds at higher yields. This takes time. But what we would see is over time, and we're 2 years from the last hike, over time, you would see net interest payments for the business sector go up. You would see household debt servicing costs go up. You would see money supply contract, and you would see business investment slow down. And we're actually seeing none of these things. Net interest payments have fallen straight down this cycle. The debt service ratios for households are near the lowest ever, and they've been flatlining for 2 years now after the rate hikes. And then, looking at CapEx is exploding higher, and money supply is reaccelerating. None of these things suggest that policy is restrictive at all, or even was to begin with at any point this cycle. And if interest expense is not biting, then you're not going to see economic activity be curtailed as a result of rates. Now, it doesn't mean the economy can't slow. There's a pretty big policy set from the White House that may have impacts on the economy, but it would not be tied to the stance of monetary policy and where rates are. And I think that's very, very important. So that's the second way. And then the third way is financial conditions. Financial conditions are the way that monetary policy transmits to the economy via markets. And so we're just not seeing that at all from the equity market, from the currency market, even the bond market. None of these major components of financial conditions are imposing any restraint on the economy. In fact, they're doing the opposite. They're stimulating the economy. And so, we have very high equity valuations. I posted a tweet a week or two ago that was a tongue-in-cheek review of the June 1999 period, where it was another cycle where we had, huge tech innovation, the internet. Now we have AI, led to a huge run up in the equity market, and the Fed was concerned about that in '99. I compared the metrics of then to today. Every single thing that caused them to hike then would make them even more hawkish today. And so that just shows you how loose financial conditions are and where the metrics are. So to me, monetary policy is loose, not tight. And that really upsets people whenever I say this, because rates are higher than they have been for 2 decades. How is this possible? But the data tells the story, and that's what I'm saying.
Well, thanks for telling us the story. A lot of great insight there. I want to kind of drill down on this idea of fiscal dominance and the Fed's mandate. As you said, their dual mandate is price stability, inflation measures, and then full unemployment measures are what drive a lot of that. For our audience, in last week's episode of Milk Road Macro, we interviewed Jim Bianco. He also shared a lot of insight around this. And I asked him about this idea of fiscal dominance. And so to explain for our audience what that means, President Trump has been attacking Jerome Powell a lot. As recently, again, he resumed this morning, saying that reducing interest rates by 3% could reduce our debt payment, or our interest payments on our debt, rather, as a country by $1 trillion a year. So he's pushing very hard to get this rate cut for that reason. But that would be fiscal dominance. How important in your mind is it to maintain the Fed's independence and to keep fiscal considerations out of monetary policy choices? Tell us a little bit more about that.
This is the biggest risk to the macro outlook of maybe my entire career. And I've been through the GFC and COVID, but this would be something that is not easily fixable. Like, those were not easily fixable, but we threw enough money at the problems that we fixed it. This would be the opposite. And so I think this would not make for easy solutions. On top of it, with the sort of the people that Trump is eyeing as Fed chairman candidates, it doesn't look like they would show any seriousness on this issue. So the issue will persist for a very long time. Look, there have been periods where the fiscal deficit grows substantially for reasons that require the Fed to monetize it. The two big ones in particular were World War II. This was life or death to save democracy around the world, to stop the Nazi regime. Second is COVID, when we had mandated government shutdowns and a major shortfall, and the potential that numerous things in the economy could just cascade and fall apart. In these cases, the Fed came in and monetized the debt, and that was very important. Now, what the president is asking for now is to accommodate loose fiscal in a peacetime, just due to choice, right? He didn't have to pursue loose fiscal. He could have let the tax cuts expire. I understand why he didn't want to. The political world, favors growth, not recession and austerity. I understand that, but he made a choice to continue to spend 7% of GDP budget deficit in a peacetime setting when the economy is at full employment and above target inflation. And so asking the Fed to accommodate that is effectively saying, ignore your mandate. And they can't ignore their mandate. We would rapidly overheat. We would get significant amount of inflation as a result of this, and it would be very, very difficult to rein that in. I already think we have a big inflation pipeline coming. This would make it substantially worse. I did a Goldman Sachs had a great study on this. They were basically reviewing Alan Binder, former Fed vice chair, his work, his research on when independence is threatened by the government. This is not something that we have a lot of case studies in developed economies. This is typically an emerging market thing, right? Like think about Turkey in recent years, think about Brazil many times, or Argentina and the lasting damage it did to Argentina. The one time that we can really talk about this, was one post World War II, and the second was Nixon. And in fact, post World War II, inflation was out of control. It was, 10%. It was really, really hot. And when the Fed and Treasury decided to separate in 1951 to restore Fed independence, like clockwork, inflation ended up coming right down as the Fed lifted their yield curve caps on bonds. Bond yields went sharply higher, and this curtailed inflation, and inflation stayed low for a solid 15, 16 years. So they achieved stability by independence. Obviously, we know about the 1970s and Arthur Burns. And so it's very, very concerning to me that they're potentially doing this. I think they're already chipping away and undermining independence, and it looks like what will happen next year is even worse for this. And I don't see the Fed really fighting back. The research that I referred to from Alan Binder and Goldman basically said when you see attacks on independence, you get higher inflation, you get a weaker currency, and those go hand in hand in higher inflation, but you get no GDP benefit. And I think that is the really key thing. The trade-off is not there, right? I think for a White House that seems to want to grow their way out of the debt, it wouldn't actually generate the growth necessary to do so if you send inflation sharply higher when wages are 4%. They're not 7% like they were a few years ago. This will be really, really bad for the economy, in my opinion. So this is the biggest risk that I see, and it's a really idiosyncratic risk that is hard to, weight the probability of it, but it looks increasingly likely this is the path we're headed down.
In traditional finance, whales use the Bloomberg terminal. In crypto, they use Definitive, the trading terminal built by Coinbase alumni, which lets you trade across every major chain out there. Definitive's combination of low fees and advanced order types like limit, stop loss, and take profit make it one of the best on-chain trading experiences there is. The kicker, Milk Road listeners trade free on their first $25,000 in volume. Visit milkroad.com/definitive and start trading like a pro today. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn.
Gotcha. Appreciate that. So I want to kind of drill in a little more context on this. You brought up Arthur Burns and some lessons from history. I read your Substack piece, The Contenders, about potential replacements for Jerome Powell with great interest. So I wonder if you could tell us a little bit about who you think is most likely to replace Powell. I've heard a lot of people saying no matter who it is, it's going to be a quote unquote sycophantic person who's going to do whatever Trump wants. So who do you see as most likely to succeed him? And then what are some lessons from prior chairmen like Volcker, like Burns, that you think would be the most instructive as far as guiding policy going forward in terms of what's likely to happen or what you think should be the policy path?
I think, there's four key contenders, but, obviously names get added all the time. But the four key contenders are Scott Bessent, who's the Treasury Secretary. We know him well. Chris Waller, who's a Fed governor at the moment, and then the two Kevins, Kevin Hassett, who's in the Council of Economic Advisors, and Kevin Warsh, also a former Fed governor who left the Fed in 2011. I think Besant is well known. I'll focus on the other three, mostly. Waller to me is probably the most dangerous. And the reason I say that is, you kind of alluded to it, like the sycophant, kind of thing where I think if it's either of the two Kevins, it's entirely possible that the rest of the Fed committee will see through what their intentions are and will resist, potentially, I don't know for a fact, but resist taking policy where it is dislocated from economic conditions, taking policy rates below what economic conditions, are appropriate. I think it's possible the committee would, try to fight and retain independence from such candidates. I'll get into what those two candidates, what I found interesting in researching those two candidates in a second. But Waller has a pretty big respect on the committee. The issue is he gave a speech last week that to me was one of the more ridiculous Fed speeches I've ever heard. He first gave a speech in June, and in June he said, here's the reasons I think July is live for a rate cut in his mind. Okay. But then we've had every single data point improve since then. Unemployment rate fell 0.2%. And, like I said, the two sides of the mandate do not warrant acting here. He ignored all of that and basically made three assumptions. He assumes the labor market will weaken. He assumes tariffs will be transitory. And he assumes the neutral rate is 3%. Since I make those assumptions, we should cut today, right? That is very dangerous to be thinking this way when the Fed has continuously had the wrong economic projections throughout. Too optimistic on inflation, too pessimistic on growth, too pessimistic on unemployment. And they've just continuously been wrong 4 years running. And, just running on assumptions to me is dangerous. And I think he might be able to persuade the rest of the committee to do things that they otherwise would not consider if it was a new chairman. But this is just my assumption that is what makes him more dangerous. If I go into the other two Kevins, what I really found interesting was going back through their old research and old views. So Kevin Warsh has traditionally been a hawk. He was a hawk before Trump took office. He was critical of the rate cuts last year. He didn't think they should have cut rates at all last year. He is very much against the balance sheet policies and QE and things of that nature, in particular, which juice financial conditions beyond what they should be doing. And so, I found, by the way, he was hawkish in 2007, which is clearly not a good call. So, I find it interesting that his views have just done a 180, now. And one of the things that I found interesting is he says we should shrink the balance sheet so that we can accommodate rate cuts, which is actually, he said that before, and that actually makes sense to me. If you shrink the balance sheet, if you actually sell bonds out of your balance sheet into the market, you'll raise the term premium, you'll steepen the curve. That will tighten financial conditions. You'll probably get a 10-year like 5.5. It'll tighten financial conditions. Risk assets will moderate, but that would allow you to cut rates. The issue is, I don't think that Trump would accept this, and that's why I say that. I think like saying that is nice in theory. The odds of him implementing that seem very, very slim. Kevin Hassett, I think, was also very interesting. In 2009, he wrote a research paper on how to deal with the growing fiscal deficit, obviously very important today. And he had a few different ways that it could be tackled. And again, I find it interesting that he's ignoring them today, his own words. But he said, it's more impactful to cut spending than to raise taxes. Fine, they're not raising taxes, but they're clearly not cutting spending. They're not listening to his own prescription. And he said the other way to deal with the deficit is to inflate your way out of it. However, he's very clear about this. It has to be surprise inflation that nobody's expecting. And if you look to what's being discussed today, nobody thinks that would be a surprise. So that inflation would be well telegraphed, which means as soon as they start down this road, bond yields will soar, right? Because it's not surprise, it's telegraphed inflation. Inflation expectations will go up, and so will yields. And so then you won't be able to inflate your way out of the debt. So I find it interesting that his own current, discussion on these topics is very different than his own research. If I had to take a bet, I think Hassett is the loyalist who will do Trump's bidding, and I think he's more likely to get the role than Warsh, which has some contradictions in what he's talking about. Hassett's been with Trump in both terms, and so I think he's the loyalist, that'll get the job. But we'll see.
Gotcha. I really appreciate the analysis and the depth on that. I think that there's a lot of things that are kind of deep in the weeds on some of these things that we'll have to, see how some of these things play out. I don't think anybody knows exactly what's going to happen, but I do think it's something to keep in focus as we go forward here. Obviously, there's another meeting of the Fed's FOMC next week, so we'll be following closely what news comes out of that meeting and keeping the audience updated on that. I want to pivot our discussion now more in the direction of what this means for Wall Street, right? Leave the Fed on Constitution Avenue and talk about what this means for global markets. And I thought a good place to maybe start, you've written a lot about something that you call the dollar doom loop. I wonder if you could explain this concept and sort of the mechanics of this and how you see this playing out as we go forward, especially in the context of a lot of tariffs and trade negotiations that are happening right now.
Sure. The original thought behind tariffs and the 2018 experience was that the dollar would strengthen. So tariffs raise import prices directly, right? The price that we pay for goods that comes into the country is raised. Obviously, it depends how much they pass through that to customers, but it raises import prices directly. The thought process was the dollar, because the US economy was so much stronger than the rest of the world coming into this year, that the dollar would strengthen and offset, some of this. China may not have allowed their currency to weaken enough to fully offset it, but it would offset, some of it. We've obviously seen the opposite, and the dollar is basically the release valve at the moment, which is the foreigners and markets basically, judging the credibility of these policies. And they're judging them as inflationary, which I agree. But on top of it, you see the dollar is driven primarily not by the 10-year yield, which is at 4.4%. It's driven by the front end. And if you look at 2026 SOFR contracts, we're about 3.2%, give or take. We're pricing in a material amount of rate cuts in spite of higher inflation, and the dollar rejects this. And so the dollar has been selling off pretty consistently since March, when trade wars really started ramping up. It has been basically voicing its displeasure with this policy quite loudly. The doom loop thesis is something that happened in 1979, where when you have policymakers that they want to have their cake and eat it too. They want it all. Right? They want to stimulate the economy, but they don't want to deal with inflation. Effectively, that's what we have here from this White House. And in 1979, the dollar just continued to weaken no matter what they did. They were trying everything to try to stabilize the dollar, and the dollar just continued to weaken because of the inflation that was out there and the lack of seriousness from policymakers to deal with it. And the problem is, the more the dollar weakens, the more inflation actually goes up. So you have almost like a continuous feedback loop where inflation makes the dollar sell off, but then the dollar selling off will actually raise inflation. And the more that happens, the long end of the curve starts to respond to that. The 10-year and the 30-year yields start to respond to that. So we saw in the week around Liberation Day a violent move in the dollar as the risk assets were getting destroyed, the front end of the curve was rallying, pricing in deep rate cuts. So the dollar took this very badly and violently. And some of this is foreigners saying, "Hey, I need to hedge my U.S. assets." Some of it is, I want to dump my U.S. assets. We haven't seen too much of that yet, but it could happen. And the tricky thing was, as the dollar kept selling off, at some point the long end of the curve started also selling off. And so this can get out of control if they undermine Fed independence, if they cut rates to the levels the president wants, which are inappropriate, if they ignore economic conditions, and do inappropriate things, the dollar becomes a key constraint. And so the doom loop basically says that the more the dollar sells off, the more that we'll get inflation, and that will eventually become, a constraint on policymakers and require a response. And the actual way that they can stabilize the dollar is by only doing one thing: hiking rates. And so the more they hold off on this, the more that they wait, let's see what the inflation is, and they may have a bigger problem down the line to deal with if the dollar keeps weakening. The impulse from the dollar to inflation, I think, is still something that people are very complacent about. And it doesn't look like it's ending. The dollar has tried in 2 occasions since Liberation Day to relief rally, and they've been like 1 day affairs, very short, and then the dollar just goes right back to selling off. So the doom loop is that whatever they want to do weakens the dollar further. That raises inflation further. The long bond will keep selling off as that happens until they get serious about inflation. It just doesn't seem like either the White House or the Fed has any plan to deal with inflation if it's not transitory. If we get a rise and it's persistent, nobody seems to have a plan for this. And actually, what they're talking about is just adding to it. Their Fed is talking about rate cuts at some point, not today, but at some point. And Waller wants one next week. And the White House is clearly not, doesn't have any policies that are going to reduce inflation. So I think that's the real issue, is that this could really run away from them. And at that point, the medicine will be much, much harsher than it is today.
The dollar has been dropping all of 2025. I think it's down around 11% on the DXY index. Bank of America, we saw reporting from them earlier this week saying that the most crowded trade, in other words, the most popular trade in the market right now, is actually shorting the dollar. It's more popular than going long on gold or on the Mag 7. So it seems to be market consensus. It's also, I think, the stance of the administration that they are now pivoting from austerity or trying to reduce government spending towards running the economy hot to sort of grow our way out of this. And it almost seems like they think that there will be some deflationary pressures from these tariffs of like fewer dollars sent overseas and growing our way out of this. Do you see that as being in any way a viable policy path to deal with this inflationary pressure? Or do you think that this trade will stay on, that this trend will continue? And how far do you think it goes before they do have to, like you say, get serious about it?
Every few years, there's a macro trend that is like a multi-year trend that, it gets crowded, and macro PMs around the world don't want to ever let it go. This is one of them. And so I think what we've seen is it gets very crowded. It did get very crowded 2 weeks ago. It's I'd say 50% of max of what it was in positioning. A big reason for that is the Japan election, and the dovish turn from the Bank of Japan turned yen positioning from extremely crowded longs to a little bit short. And I'm sure that's also now being unwound. So I think we're seeing shorts added back. The euro has been a popular trade, obviously, and I think it is crowded. And frankly, I'm long, full disclosure, the euro, I have upside in option space. So I think, this is one of those trades. Like being short the front end of the curve in 2022 was crowded, and there were relief rallies, but it was absolutely the right trade to focus on being short the front of the curve as much as possible and taking advantage of fading those relief rallies. It was a full year trade, and positioning alone was not a reason to avoid that. Really, it was just a Silicon Valley Bank that broke that trend. And so, I think it is unfortunately going to continue as a big macro trade for multiple years to come. The dollar tends to go in these 10-year cycles, and we had a 10-year bull cycle from 2014 to till this year, to the beginning of this year. I don't believe them on inflation. I, wrote a note called "The Crisis to Come." The note was basically it's not just that I see so many inflationary impulses that are all pointing up, and they all have different timing to them and lags to them, and it's not like I'm saying we're getting a 2022 inflation. It's just that I see a lot of inflationary dynamics turning up, and I don't see policymakers showing any seriousness on this at all. So no, I'm not in the same camp with them that it's going to be transitory. And I think it's important to, if you want to, we can talk about tariffs specifically and why my view is very different than the consensus, which does see it as, the consensus sees it as transitory. I don't see it as transitory. And if you want to talk, we can jump into that.
Well, I think we've gotten a lot of insights and education on a lot of things here from you. I don't think we have time to get to everything we want to. We're coming up on time here, so to sort of like bring this home. I think there's a couple questions I want to ask, so I'll kind of combine them into one. But I think, as we move into the second half of 2025, I think a lot of investors want to know how they should be positioned to deal with some of this uncertainty, reacceleration of economic activity for sure, but also weakening dollar and inflation risks. I'd seen on your Twitter that you had posted about you have a valuation framework for Bitcoin that says that it's at fair valuation now. So I'd like to hear, your thoughts on how your thinking rather has evolved on Bitcoin as an asset, and how you're thinking of that now and going forward. And then, just some, without giving obviously specific financial advice, some things investors should pay attention to or to focus on as we go into the second half of this year.
I think when we're faced with inflation that's not going away and probably going to accelerate and not be dealt with, you have to look at what they call as debasement trades, or inflationary trades, or scarce assets. So from a macro perspective, I think the clear way to express the sycophant Fed trade or independence trade is a steepener. That trade probably has a long way to go. I don't think they'll be cutting this year, but 2026, I do have longs there versus shorts in the back end of the curve. Like I said, we talked about the dollar. I think that'll be a continuous theme. It doesn't mean you jump in, specifically today, but I think it's a continuous theme. And then it's hard assets, scarce hard assets. So I've been, very focused on commodities all year. I rotate around. I don't try to just stick with one, but I do think that our needs for copper are explosive over the years to come. It's a little bit overbought now. But I do think this is a theme you want to have on. Silver is I think catching up to gold in a big way, and so I think silver is a good one. Bitcoin is another, and my prior view on Bitcoin was that it was worth zero. I had a long-standing view that it was fundamentally worth zero. The big reason that I had that view was that it's very impressive technology, the blockchain technology, but it's open source code, right? So if we were to go to something that isn't open source code, it would be the equivalent of like Apple's, iStore, the Apple iStore, or Microsoft Office, or any sort of technical application that we use on a regular basis. They have a patent on it, which means there's a reason why it's not been recreated, right? Facebook has a near monopoly on social media via Instagram and Facebook. Other than X, that's the dominant player. When you have a patent on your technology, it can't easily be recreated. Bitcoin, on the other hand, has no patent on its technology. It's open source code. So I've always viewed it as Bitcoin has a theoretical limit of 21 million supply. But because it's open source code, it can be copied infinitely to other coins. And the crypto ecosystem will expand in supply infinitely, which I think is not something well understood by most people. And that leads me to a conclusion of zero. It doesn't mean zero today. It just means that fundamentally, there's a limit to how much it can, we can see. That being said, I had to change my view. And my view really changed when I saw the Trump administration's acceptance and encouragement of it. And the fact is, the adoption of it. We've had many fads in finance in Wall Street over the decades that once they crash, they just cease to be important. It was a fact. Everyone was all about GameStop, and then it crashed, and no one talked about it for 2 years, right? Things like that. ARK in 2021 was the greatest investment in the world. It crashed 80%, has never recovered to its high again. Bitcoin has proven to be resilient, and you've had 80% declines, 60% declines, just enormous declines. Not too long ago, 2022, it had a huge one, and the adoption of it only increased. It didn't decrease. And then now we have the White House, effectively encouraging it with the Genius Act and the use of stable coins and things like that. So when I saw that, I had to model it. I created a fair value model for it. It's done a really good job of approximating value for it, and I trade it on a systematic basis. It falls into the same sort of scarce assets world that people are gravitating to when we have the inflation outlook that we have, and the sort of reckless policymaking dynamic. It fits into those categories. So I just think you have a whole basket of these scarce assets, and you rotate as they get crowded. You get out, wait for them to have a little bit of a correction, get back in. Like right now, silver just had a huge reversal today. Maybe we're in a consolidation correction. I'll get back in as soon as I see that, so on and so forth. But I think that's how investors should be thinking about it. Now, equities are also a scarce asset, and equities have earning potential. So equities are well positioned for inflation, but there's a limit to that. At some point, inflation gets too high, and we don't know if it'll reach that level, where then equities start to suffer. So, in a 2 to 4% inflation world, equities do fantastic. Revenues improve as pricing power improves for businesses. That'll make earnings better. They're obviously scarce assets, and can do well when the dollar weakens and do well with rate cuts and things of that nature. But at some point, inflation gets too strong, and then you have an issue. And so, I would just say keep that in mind in the back of your head. That's not a today story, but equities are also in that group of assets.
Danny, absolutely wonderful to get you on the show today. Thank you so much for breaking down all of this macro, somewhat madness at certain points. It's difficult to wrap your head around this, and you do such a wonderful job of it. Really appreciate you joining us today.
Thank you guys for having me. It was great to chat. I hope it was helpful for your listeners, and hopefully people on Twitter were able to jump in and join as well. So thank you guys so much for having me on.
Right on. Everybody, let us know what you thought about today's episodes in the comments. And as I said earlier, please, please, please make sure you subscribe to Milk Road Macro on YouTube or X or Spotify or Apple or wherever you are listening to this, because starting next week, we are going to have 2 macro episodes per week that are going to be aired there. They won't always be on the Milk Road Daily Show. Thanks for tuning in, y'all. I have to remind you, though, none of today's episode was financial advice. I'm not your investment advisor. Danny is not your investment advisor. John is not your investment advisor. You should always do your own research. And if you need help, you should speak to a professional investment advisor. Have yourselves a wicked awesome day. We'll see you back again next week. And finally, I've got to give a shout out to our partners over at Nexo. Have just partnered with the DP World Tour, one of the leading golf tournaments in the world, 45 tournaments across 4 continents, and they're going to have the Nexo Championship debuting this August in Scotland. So keep an eye out for that, because this is one of those things that feels very marketing talk, but I get super excited because when you think about sports and the crossover with the attention that it has and how many leading global brands are sponsoring massive sports tournaments, it's pretty exciting to see crypto brands sponsoring large sports tournaments as well. So hat tip to Nexo. Way to go, guys. Thanks as always for doing what you guys do in the space. Thanks for tuning in, y'all. Have a wicked awesome day. We'll see you back again tomorrow. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.